All right, we're going to do a video for merchandising entries. The Menards company is going to be making journal entries, and we'll post to T accounts. First thing they're going to do is the Menards company is going to purchase from OLB Corp merchandise for $15,000. The terms are 110 N30 FOB destination. What that means is that we don't take ownership of it until it gets to our loading dock. So the shipping, any freight or shipping that would be charged on this shipment should be paid by OLB. We're purchasing it on the 3rd with terms of 110 and 30. So if we pay for it by the 13th, 10 days later, we should get a 1% discount. Here would be the journal entry and debiting merchandise inventory and asset, increasing that, crediting accounts payable for OLB Corp, a liability, increasing that. And here we are with our T accounts. It's a debit. We're going to take the debit to merchandise inventory over to that account, and the credit to accounts payable over to that account. And here they are on the July the 3rd, a debit to merchandise inventory and a credit to accounts payable. We're going to do the same thing in the subsidiary ledger. We're just going to mirror what happens here. This doesn't mean we've entered the credit amount twice. It just means that we're showing it in the subsidiary ledger to OLB Corp as well as into the general ledger account. The second entry, we sold merchandise to Brill Company for $11,500, credit terms 210 and 60. That means if they pay for it within 10 days, they get a 2% discount. FOB destination means that we are paying the freight on this one because it doesn't ownership doesn't transfer to them until it reaches their loading dock. The merchandise costs $77.50. Since we're using the perpetual inventory method, we have to record the cost of goods sold. So the revenue entry looks like this. We're going to debit accounts receivable Brill Company for $11,500 and credit sales revenue for $11,500. Here's the T accounts. You can see a debit of $11,500 to the general ledger account, and the same thing mirrored in the subsidiary ledger to Brill Company, the credit over here in sales revenue. Now we have to record the cost of goods sold, and that will be a debit to the cost of goods sold account for the cost of the merchandise we sold, and a credit to merchandise inventory. And here we have the credit to merchandise inventory on the 7th and the debit to cost of goods sold on the 7th. The next thing, we purchased merchandise from Rupert Company, $14,200, terms 110 N45 FOB shipping point. So if we pay for it within 10 days, we get a 1% discount, and we have to pay the shipping. FOB shipping point means that we take ownership of it when it's shipped. It looks like this. Debit merchandise inventory, credit cost of goods sold, credit accounts payable, Rupert Company. We're going to go to the T accounts. You can see the debit to merchandise inventory, the credit to the general ledger accounts payable account, and also the credit being mirrored in the subsidiary ledger to Rupert Company. We paid $300 for shipping charges related to this sale to Brill Company. Remember, it was FOB destination. So that means we owned it while it was in shipment. So we're going to charge that to delivery expense or freight out or freight expense. And those are some of the normal accounts you'll see. So we're going to debit delivery expense and credit cash. debit of $300 to cash, a debit of $300 to delivery expense. All right, the next one, Brill returns some merchandise to us from July the 7th. So we sold Brill this merchandise and we paid the delivery expense. And then on the 12th, they returned some merchandise to us. So we have to take care of the reversal of the revenue and the reversal of the cost entries. The first one, we can't actually reverse revenue. We debit a contra revenue account called allowance for doubtful, not allowance, sales returns and allowances, and we credit their accounts receivable to show that they don't owe us that anymore. The cost was $14.50. So we're just going to we do actually get to reverse the cost entry. We debit inventory and credit cost of goods sold for that amount. Here's the debits and credits. For the revenue entry, it'll be a debit to sales returns and allowances and a credit to accounts receivable. That'll be mirrored in the subsidiary ledger to Brill Company. On the cost side, it'll be a debit to merchandise inventory, where we're putting this merchandise back into our own inventory, and a credit to cost of goods sold. All right. We negotiated with Rupert Company. And we received a price reduction. We purchased from Rupert on July the 10th some merchandise, 110 and 45 FOB shipping point. They would pay the freight, and we got a $1,200 price reduction. We didn't actually return the merchandise to them. But we're just recognizing here that we don't owe them that merchandise now, or that we don't owe as much for that merchandise. That merchandise cost us $1,200 less than we expected. So that will be a debit to their accounts payable and a credit to our merchandise inventory. Go to the T accounts. You can see the debit to accounts payable mirrored in the subsidiary ledger, and then the credit to merchandise inventory. The next entry, at OLB's request, Menards paid $200 cash for freight charges on the July the 3rd purchase, reducing the amount we owed. So we don't actually have to pay the freight on this guy. It was FOB destination. We were purchasing it. We didn't take ownership till it got to our loading dock, but we've agreed to pay the freight for them. So we're just going to debit accounts payable OLB Corp and credit cash. It doesn't go into our inventory. This doesn't reduce the inventory at all. They just said, okay, if you'll pay the freight, we'll call it even, and you pay the same thing that you were going to pay for your inventory less that $200. So we're going to debit accounts payable OLB Corp and credit cash in this case. So let's look at the T accounts. We're debiting accounts payable, mirroring that in the OLB subsidiary ledger, crediting cash on the 15th. We received the balance due from Brill Company on July the 7th for the July the 7th sale, less the return on July the 12th. So the best way to do this is go to the T account for Brill Company. Since we've been recording the transactions as we went, we can get the balance in the Brill Company account here. The balance is $9,500. Of course, it's a debit balance. It always will be for an asset. So we owe them $9,500. and it was 2% discount if paid by the 17th, 210 on the 210 N60 on the 7th. So we're here on the 17th. We're going to be they're going to be paying that to us. I mean, less the discount. So they owe us $9,500. That's a $190 discount. So the entry looks like this. We're gonna credit accounts receivable for the whole amount. We're gonna credit accounts receivable for the whole amount they owe us. They don't owe us anything anymore. We're gonna debit sales discounts, another contra revenue account, for the amount of the discount that they've earned, 2% of 9,500, and then we're going to debit cash for the rest. So they only had to pay us 9,310. The entries look like this. Oops. So we have a credit to accounts receivable. I forgot that one. I'm going to I had one thing missing there. So here we have go back to the entry. We have a $9,500 credit to the subsidiary ledger and to accounts receivable, 9310 debit to cash, 190 debit to sales discounts, all on July the 17th. So here's the 190 debit to sales discounts. Here's the 9310 debit to cash. Here's a $9,500 credit to accounts receivable, which is mirrored in the subsidiary ledger. And if you wanted to do this, the balance now is zero. We had a $9,500 balance and a $9,500 payment, so they don't owe us anything anymore. Well, let's go to page 2 now. We paid the amount due Rupert for the July 10th purchase. So let's go look at the July the 10th purchase. We debited, it was 110 N45 on the 10th. We're paying this on the 20th, so it's in the discount period. And Rupert Company, let's just see what their balance is. Their balance is $13,000. We purchased $14,200, and we returned or got a credit issued to us, a discount issued to us of $1,200. You can see it here. We purchased $14,200 from them, and here we debited them for the $1,200 because of a price reduction. So the entry looks like this. You can come up with the discount the same way. $13,000 we owe them. 1% discount. 110 N45. So 1% of 13,000 is $130. That meaning that we have to pay cash out of 12,870. Here's my entry. I'm going to debit accounts payable and the subsidiary ledger for 13,000, credit inventory for 130, and credit cash. When I'm the purchaser and using the Perpetual system, I'm going to credit inventory for the amount of the discount that I earn. If I'm the seller, the discount is going to be debited to sales discounts. So in this case, I'm the purchaser. I'm going to credit accounts payable for the full amount, $13,000 that we owed him. Here it was. Here was his balance, $13,000. We're going to debit accounts payable for that, debit the subsidiary ledger. We're going to credit merchandise inventory for 1% of that, and credit cash for the net amount, the difference there. We sold merchandise to Brown Company for $11,000. We know we've got to make 2 entries here. So a debit to accounts receivable Brown and credit to sales revenue for $11,000. The cost was $7,000. Debit cost of goods sold, credit merchandise inventory for $7,000. This is 110 and 30. So as long as they pay us by the 31st, they get a 1% discount. Let's do this one first. Accounts receivable brown and sales revenue. Accounts receivable. Well, let's start. I misplaced this one. I put this one in the wrong place. So I'm going to just remind us that we got these in the wrong place. This was the 17th. This was the 21st. They should be reversed, but I'm not going to mess with it right now. This would be the debit to accounts receivable and the debit to accounts receivable brown, the credit to sales revenue. Debit cost of goods sold, credit merchandise inventory for $7,000. Let's hope we got all that. And that gets us done with that entry. All right, back to here. So we've got all those posted to the T accounts. Brown requested a price reduction on the 21st on the sale from the 21st. This sale we just did, they requested a price reduction because it didn't meet specifications. So we gave them a price reduction of $1,000, but we didn't. We just allowed them the difference. We didn't take any money, any inventory back. So it's going to be a debit to sales returns and allowances and a credit to accounts receivable brown. All right, so here are the credits, a $1,000 credit to accounts receivable and to the subsidiary ledger account for Brown, and a debit to sales returns and allowances. And in this case, it's an allowance, so we're not going to put anything back into our inventory on this one. Let's see. We received Brown's cash payment now. Let's look at their account. His subsidiary ledger. So Brown's balance, of course, is $10,000, and we're paying it within, or he's paying it within the discount period. So he gets a 1% discount, 10,000. 1% of that is 100. That's the debit to sales discount. The debit to cash of 9,900. So and let's see. I'm going to get accounts receivable in here. I'm going to have to enter it myself. I evidently erased it. So here we go. We have the $10,000 reduction, credit to accounts receivable, a $10,000 credit to the subsidiary ledger account. We have a $100 debit to sales discounts and a $9,900 credit to cash. Debit to cash. Hang on a second. There we go. Let's get that corrected. It's a $9,900 debit to cash, a $100 debit to sales discounts, and a $10,000 credit to accounts receivable. All right. I think this is the last one. We're going to pay OLB for the amount due on the July 3rd purchase. And this is outside the discount period. The discount period was 110 and 30, and we're obviously here the 31st, we're paying it outside the discount period. So we're just going to see what we owe OLB, and we're going to go ahead and pay that. We owe them $14,800, so it's just going to be a debit, $14,800 to accounts payable and the subledger, and a $14,800 credit to cash. And that's it. Debit to accounts payable, credit to cash. We have the debit to accounts payable here. And to the subledger, let's debit. Let's see if we got a debit to the accounts payable account too. There we go. We do now. So anything that happens down here in the subsidiary ledgers has to happen up here. And that's it. That's all those little entries we had to do. If you have a question, maybe go back and review. Take care.